navigating the uncertainty, what volatility can do for you. So we're going to go over a few different areas on how that kind of pertains to your portfolio. So just a few disclosures that I always have to go through as a financial advisor. So just that diversification asset allocation strategies do not assure profit or protect against loss. So just a little bit of background information on myself. So many of you probably already read this throughout the advertising of the event, but I've been with Merceburger Financial Group for just about a little over 5 years. I graduated from Oshkosh with my degree in finance and psychology, and I currently work as a financial advisor and director of financial planning with the firm. So these are going to be the key areas that we're going to focus on today. So asset allocation, importance of diversification, action items to take during times of volatility, the best practices to take advantage of during times of volatility, the importance of a financial plan, and then I'll do a brief market update towards the end as well. So the first area that I want to cover today has to do with asset allocation. So when I'm focusing on asset allocation, I'm really talking about your ratio between your fixed income and equity exposure inside of a portfolio to get to that proper asset allocation. This really has to do with the amount of time horizon you have until you reach that said goal and your tolerance for risk to decide really how you should be allocated inside of a specific account. This may be different based on the type of account as well that you're talking about. So for instance, if you have a retirement account that you're investing into for retirement and you have quite a few years left until retirement, that's going to be a type of asset allocation where you have the ability to take a little bit more risk. If it's a goal that's maybe like a 3 to 5 year time horizon, that's where you might see more of a conservative approach. So you may have a little bit more fixed income in there. The reason why asset allocation is so important during times of volatility is because it has to do with how much you'll be affected when you do go through those market pullbacks. So what I mean by that is if you have a portfolio that's completely equity positioned or completely invested in the stock market, when we go through times of volatility, such as what we had seen in March, you're going to feel that in the entire portfolio. Whereas if you are looking at an asset allocation that's maybe a 50-50 split, you would have only felt maybe about half of the burden that we had seen over the last couple of months. So I will go through some sample allocation blends. And this is really just to illustrate how portfolios can be set up based on what their goals are intended for. So, that you can have portfolios that are anywhere in between these 5 areas, but these are, again, just a couple sample allocation blends to illustrate on a scale of what we call 1 to 10, how aggressive or conservative you might have a portfolio position. So over on the left-hand side, the conservative portfolio, that's really going to be more of our short-term goal type allocations. You're going to have pretty much all fixed income in there with maybe a little bit of equity exposure. Same holds true for the moderate conservative. So you may have a little bit more equity exposure in this type of setup. However, it's probably still going to be that short-term goal that you're looking to achieve here. Examples of this may be you have maybe like a 3 to 5 year goal for purchasing a down payment on a home or a second home or saving for an emergency fund, those types of goals where the time horizon, of course, is going to be shorter. As we move further down the scale, the moderate allocation, that's going to be, right smack dab in the middle. So when I say on a scale of 1 to 10, we're talking about a 5 here. So a moderate 50-50 blend. Typically, this is the type of portfolio that you would see for most individuals as they get to retirement, and then now they have to live through retirement. So, retirement's the end goal for us to all get there, but then you also have to think about the future of living, 10, 15, 20, 25 years into retirement. So you still do need to have some type of equity exposure in that portfolio for those long-term goals, but you just can't afford to take as much risk as you were doing in those earlier years when you were accumulating assets. And then our moderate aggressive to aggressive portfolios, those are going to be the ones, of course, that are our longer term goals. So for our younger individuals who have quite a few years left again until retirement, that's where they're going to see their portfolio situated, or how you should be able to have those portfolios situated. And that really has to do with the fact that you have a lot of time to recover from market volatility, that you can afford to take those losses as we go through times like we had just seen in the recent months, because you can't touch the money, or it's not going to be touched for that goal for quite some time. So again, just a couple different allocation blends. You may find portfolios in between these, but just on a scale again of 1 to 10, moving from left to right, that's kind of what you would see when you're setting up a portfolio, depending again on that time horizon and what that goal is. So again, when deciding on proper asset allocation, the things you really need to consider is the time horizon for the goal and the specific account that you're looking at, as well as your tolerance for risk. So I usually will recommend to people, you know, if what's going on in the markets is keeping you up at night, that's maybe where we need to reevaluate what your actual risk tolerance is, to determine if your portfolio should be as situated as aggressively as it maybe is. The second piece here, diversification. So this takes the asset allocation a little bit further. So, you know, first we were talking about our fixed income to equity exposure, and now we need to make sure that we're going to be capturing all those areas of the market to be able to reduce the risk inside the portfolio. So when we talk about diversification, we're talking about two different areas. We have our asset classes as well as the sectors of the market. So the asset classes on the equity side, so your stock market type of investments, that's where you're going to want to make sure that we're hitting your large cap, mid cap, and small cap type companies on the domestic side. And then on the international side, you'll have your established international companies and your emerging markets. And then on your fixed income side, or your more stable type of investments, that is where you will see, you know, your government type treasuries, money market instruments, corporate bonds, and your high yield bonds. So by making sure that you capture all those areas of the market, that's really going to help with diversification in the portfolio. Then if we take it one step further, we want to make sure that we're diversifying into all the different sectors of the market. So that those are going to be listed there on the right-hand side. And the reason that we're doing this, of course, is to really spread the risk out across the portfolio. So I'm sure many of you heard the term, don't put all your eggs in one basket. That's pretty much what we're talking about here. We don't want to see a portfolio that's overweighted, you know, highly to, say, tech stocks, and then if something happens in that industry, you're going to absorb a lot more volatility than you otherwise would have had we spread that risk out. So making sure that we're diversifying across the board is key when putting together any type of investment portfolio to help curb that volatility when we do go through rough times. And then the importance of diversification, again, really has to do with reducing risk and curbing volatility. So anytime you invest in the stock market, you're taking on what's called market risk or systematic risk. So that is a risk that you're not able to do anything about. So that's something that anyone who's investing in the stock market, you just take that risk upon yourself by doing that. Examples of this would really be interest rate risk, inflation risk, exchange rate risk, political risk. So all areas that you really have no control over. So how we can increase our diversification or reduce the risk inside of our portfolio is by taking advantage of diversification to diversify the unsystematic risk. And that's really the risk that has to do with investing really only in one specific company or one specific area of the market. So it's a lot more advantageous over the long term for an individual to take advantage of all the areas of the market rather than trying to market time, you know, what area they think is going to do well. Typically, if you look at what areas of the market have done well in a previous year, it's almost always going to be different than what areas of the market are doing well in that current year, and so on and so forth if you look back at history. So those types of things are the reasons why we would recommend making sure that we're capturing all those areas of the market. Our key takeaway here then is, again, making sure that we have all the asset classes as well as all of the sectors of the market. The easiest way to do this, and many of you probably are already doing it if you're investing into any type of employer-sponsored plan, is through the use of mutual funds or ETFs. So a mutual fund is basically going to allow you to be able to capture many different areas of market hundreds, thousands of different stocks by just holding that one mutual fund. So that's going to be the easiest way in order to create that diversification inside of the portfolio. You can get a handful of mutual funds and have a very diversified portfolio, which makes it a little bit easier for that individual investor. So the third area here is some action items that you can take advantage of when we do go through times of volatility. So the first one here is talking about rebalancing your portfolio. So I have two portfolios listed here. Our initial portfolio with a value of $100,000. Our original core asset allocation was about 60% equities and 40% fixed income. Then we went through some volatility. We had about a 20% reduction, and so now our value in our portfolio is $80,000. And you'll notice that our asset allocation has shifted to 40% equities, 60% fixed income. So this is very common after you go through volatility. It also works the other way around. When markets are doing really well, you'll start to see that the core asset allocation inside the account has shifted. So what's happened is, of course, as stocks are performing poorly, the idea is that fixed income typically works in the opposite direction. So your fixed income piece has performed, pretty equally or better than your equities, which have fallen. So that's why you're starting to see that the equities have less of a percentage in the portfolio, and now your fixed income has gathered more. So when we talk about rebalancing the portfolio, what we're really saying here is we want to shave off some of those earnings on the fixed income side that have done well and purchase into those equities that haven't done so well to get us back to that core asset allocation, which is this 60% equities, 40% fixed income. So what we're doing here basically is the theory of selling high and buying low. So the reason why you want to take advantage of rebalancing that portfolio when you can is because not only are you able to purchase in then at that lower price point, now the equities have fallen, but now you'll be able to rebound even better as that recovery period starts to happen. So taking advantage of rebalancing the portfolio during low points of the market is very advantageous for an individual investor. So that's typically the first thing that we'll usually recommend. Normally, we would just say you should always try to remember to rebalance your portfolio at least semi-annually. Typically, in most employer-sponsored plans, you can set up an automatic rebalance inside of the portfolio where you can pick if you want to have it done quarterly, semi-annually, annually. So we usually would recommend doing that just because it always gets you back to your core asset allocation. The reason why you don't want to drift too far away from your asset allocation is unless your actual tolerance for risk has changed, what's going to happen is all of a sudden, if we do go through times of volatility, you're going to feel it more in that portfolio than you otherwise would have. Say if it was a time from, basically the middle of 2009 to the beginning of 2020, that was pretty much the longest bull run that we've seen, or the longest period of expansion in the stock market. You would have seen portfolios get more heavily weighted towards equities. And so then when we went through the volatility that we saw in March, you maybe would have seen a little bit more of a drop in your portfolio had you not rebalanced it. So it works the opposite way as well. Portfolios may start to see a little bit more equity exposure when markets are doing really well. And by rebalancing the portfolio, you're taking away that added risk that you'll see if we hit that market volatility. So the first one here, of course, rebalance the portfolio. It's a pretty simple thing. Actually, inside of most plans, it's really just a button that you click and it will automatically rebalance it to that original asset allocation that you already have inside the portfolio when you originally set up your allocation. This is something that your financial advisor can help you with. It's something that if you have someone to talk to through your employer-sponsored plan, a phone call to them, or someone that comes in normally to review these things with participants, that's something that they are going to be really familiar with as well. The second piece here, this may seem a little hard during volatility, but putting money to work. So when the markets get really volatile and you start to see the dollars go backwards in your portfolios, it's pretty uncomfortable. It's not fun to watch. It's not fun as an investor. It's not fun as an advisor. However, this is definitely a big opportunity for individuals to take advantage if they have money on the sidelines that they are looking to invest. And the reason being here is basically that you're buying in at a discount. So everyone likes to take advantage of buying things, when they're on sale. If you are able to do that versus paying full price, that's an advantage to anyone. So I usually say, think of it as going shopping on Black Friday after everything has been marked down for the holiday shopping season. That's exactly what's happening when we see volatility like we saw in March. Now, a key thing to keep in mind here is we do go through short-term volatility once in a while where you'll see, a backwards movement of 10% or 15% and then a quick recovery like 2 days later. We saw that in towards the end of 2015, we saw it towards the end of 2018, those really short-term blips where, it's a really quick turnaround. The times of volatility like we saw in March, where we kind of talked that pulling us more into what we call a bear market, or now kind of into that recession territory, those we don't see quite as often. We haven't really been through one since the financial crisis in 2008. So if individuals can take advantage of those times of volatility, it can be very advantageous for them, really because the times that we see them, it's few and far between. So, it's been over 10 years since we've seen that volatile action where you can actually take advantage of it. So if individuals are willing and understand how that market is working, it can be really advantageous over the long term for an individual investor looking to put funds to work. And then the third idea here of action items is investing through dollar cost averaging. So this is a concept that most of you are probably taking advantage of if you're investing into any type of employer-sponsored plan. So this is really where we're investing into the account with the same dollar amount at the same time of the month. So, whether it's twice a month, every other week for payday, that's basically what dollar cost averaging is. The idea behind it is that by doing it that way, rather than doing a one lump sum version of the same dollar amount, is that you're taking advantage of the highs and the lows of the market so that over time you're averaging out how much you're actually purchasing on a share. And then that's hopefully going to be lower than the amount that average share is actually worth. So in this case, we're looking at just a 6-month time frame from January to June, with $100 for each month that we're investing. And then you'll notice that during each month, our share price is different just based on what that stock is doing. So that's going to obviously dictate how many shares that we're purchasing. So then if we look at the bottom here, our total investment was $600. We were able to purchase 88.2 shares with an average cost per share of $6.80 and an average market price per share of $7.16. So it actually cost us less over time than what those shares are worth, based on the fact that we were able to buy in at different times of the market and take advantage when those stock prices were depressed. On the flip side here, it would be making a one-time investment. So in this case, let's just put that same $600 to work at that high price point of $10 per share in January, just like it was in our previous chart. So in this case, we're only going to be able to buy 60 shares. So now we have an average cost per share of $10, but it's still, as of June, at that $6 price. So our average market price is still $7.16, but it cost us more when we did it in that lump sum investment. So that is why the dollar cost averaging can really be an advantage over time. You can even do this if it's not through an employer-sponsored plan. If you have outside investments, maybe you're investing into an IRA, or you're investing into like a 529 plan for kids' education. If you set up, a monthly distribution or every 2-week distribution or contribution, rather than, putting in that one lump sum, it can help for how much you're actually purchasing the shares at versus what they're worth over time. So it can be an advantage to you over time. And the biggest thing here too is that, especially when you're in tax deferred accounts, like a retirement account, the amount of earnings are going to be compounded with that interest over time. And then the taxes, of course, are deferred. So when you're able to purchase in at a lower dollar amount and continue to see that price continue to increase, you can see how that's going to be obviously to an advantage for you over time. So the key takeaway here, again, rebalancing the portfolio, putting money to work, and then investing through dollar cost averaging. So just some action items that you could take advantage of during the volatile times if you are able to do so. So then kind of shifting gears here towards kind of some best practices with the market, as well as talking a little bit at the end here towards the end about the financial plan. So some of the best practices, when we're going through times of volatility, it's extremely uncomfortable. I understand that, and it's not fun. You know, no one likes to see their portfolios go backwards. No one likes to see the ups and downs of the market. So some of the kind of things to kind of hang on to really is, even though it's not fun and it's very uncomfortable to go through that stuff, make sure that you're hanging on and not selling out of the markets. Because what we're doing at that point in time is we've already absorbed all of those losses after going through that volatility that we're seeing. So basically what we're doing then is we're just locking those losses in by selling out of the market at the low point. So kind of what I had already mentioned earlier, we want to, in a perfect world, buy low and sell high. We don't want to do the opposite. And that's typically what happens when individuals sell out of the market during volatility, is they're basically selling low, and then they're waiting until that recovery period starts to happen. And by the time they get back in, maybe they miss the first couple good days, 5, 10 good days. And so you're selling at that low point, and then you're not purchasing back in until that high point, getting up to being that high point. So the chances of then recovering all of those losses that you just saw during the volatile times is very unlikely. So over time, for an individual investor to just hold on during those times of volatility, it's actually going to be more advantageous for you than trying to sell out and time the market to get back in. On the other side of that, most people, when we see them sell out of the market, it does actually take them a very long time to get back into the market, because it's an uncomfortable time and you're continuing to second guess yourself. You know, are we at the low point of the market? When is the market going to recover? And it's just not something that market timing works out every single time over the long term. So if you can try to remember that during times of volatility, it's going to be a benefit to you over the long term. The second thing here is reviewing your financial plan with your advisor. So if you have a financial plan that you've already taken care of with an advisor, now is a really good time to review that plan. And that's just to make sure, you know, goals haven't changed, that you're still on track, you know, even with the volatility that's going on, and so on and so forth. So, you know, anytime that you go through volatility, it's kind of nice to be able to pinpoint all of the goals onto something that's a little bit more tangible. And that's what that financial plan is. If you're an individual that doesn't have a financial plan yet, or you're not working with an advisor, now is a perfect time to, you know, start to put that stuff together. And I'm going to talk in a little bit about what goes into the financial plan. So goals aren't just retirement. So anyone at any age can put together a financial plan with an advisor, you know, to kind of hold them accountable and keep those goals on track. So now again is a perfect time to do that. And then this kind of goes hand in hand with the financial plan, but reassessing those financial goals. So why are you worried about the volatility that's happening? Is it because your retirement date has possibly moved up, but you haven't made any changes to your asset allocation in the portfolio? Have some of your goals changed that you haven't accounted for in the plan? So this is a perfect time to reassess those financial goals to make sure that everything is still on track for how you had originally set it up when you created that plan with the advisor. And then lastly, reassessing your risk tolerance. I always try to mention that reassessing your risk tolerance during times of volatility is a lot more accurate than trying to reassess your risk tolerance when markets are doing really well. And the reason here really has to do with the fact that as markets continue to do well over time, typically you'll see what we call a bull run, or a time of market expansion, for quite a few years. So it starts to get really easy to decide that you want to have more equity exposure. And so what you're continuing to do then is moving more and more aggressive, and then all of a sudden that bubble bursts and we see the volatility that we just recently went through. However, maybe your risk tolerance really wasn't towards that higher end of the scale. So reassessing your risk tolerance during volatility, I think, is a more accurate representation, because if we go through the volatility and you really decide that you just can't watch what's going on in the portfolios, that's probably a good indication that you shouldn't be as aggressive as you possibly could be in the portfolio. Now, it's not that you would maybe make those changes right away, because we do want to make sure that we take advantage of the recovery periods in that current asset allocation. But then maybe after we go through a recovery period, like during this time frame where we're at a couple months post the March downfall, would be a good time to then maybe rebalance the portfolio to make it more in line with your actual risk tolerance. So your risk tolerance is definitely going to change during your lifetime. So as you get older, as you get closer to those goals, your tolerance for risk is just naturally going to gravitate towards being more conservative, and that's okay. That's pretty normal. And the idea there, of course, is that you just don't have as much time to make up volatile times as you would if you had the more years to wait until that goal has been reached. So again, reassessing the risk tolerance is a great thing to take into consideration as well during those volatile times. So key takeaways here for best practices: meet with your financial advisor. So, when we go through times of volatility, your advisor is very educated on what's going on in the markets. They should know exactly how to hold your hand through the volatile times and make you feel comfortable with what's going on. Take that focus off of just what's going on in the market. Because, when you look at the overall financial goals and the financial plan, which we'll talk about here on the next slide, it's the market volatility or what's going on in the market is just really one piece. So meeting with your financial advisor, calling your financial advisor, calling someone to get a little bit more clarity on the state of the market, that's what they're there for. They're expecting those calls. So that would be the first takeaway. The second one, wait to make changes in your investments until you've consulted a professional about the current state of the market. So whether or not you have an advisor, find a fiduciary to give a call to if you're wanting to have a little bit more clarity on the current state of the market before making changes in your investment, because typically, more often than not, we're going to tell you to just kind of hold tight, and that we want to make sure that you're not selling out at that low point of the market. So again, just, consulting someone that knows the background of the market, the current state of the market, they're going to be able to kind of walk you through what's going on, make you feel more comfortable before making any of those rash decisions. Remembering the long-term goals. So again, just coming back to the financial plan and just the areas that, why are you saving for these goals to begin with? That's really what's going to be important over the long term. And this short-term volatility should not be what's creating decisions that you make for long-term goals. And then the last piece here, discussing other financial related opportunities. So this really has to do client by client. There's a couple other different financial opportunities you can take advantage of during volatile times. A couple of them that I'll mention, I'm not going to go too deep into them, but it would simply be, maybe taking advantage of tax loss harvesting, doing some Roth conversions, again, purchasing more securities if you have money on the sidelines to put to work. So that's going to be client by client based on many different things, tax bracket, if clients have non-retirement assets that they have large capital gains in for taking advantage of the tax loss harvesting and so on. So, that's something that you can, again, meet with one of those professionals or talk with your advisor about, hey, is this something that would affect me? Should I take advantage of doing some Roth conversions or, whatever it might be. And then our fifth piece here is the financial plan. So I've discussed a lot about the financial plan, and the importance here is really that this is kind of what the central planning point is for getting us to the goals that any individual has. So whether it be retirement, saving for college education, trying to save for a goal, purchasing a home, again, emergency fund, whatever it might be, the financial plan is going to be the way that you're going to get there. And so this is just a graph to kind of show you what that financial planning process looks like. So typically you're going to establish your relationship with an advisor or a financial planning professional. And during the first 1 to 2 meetings, you're going to gather data and develop goals together. So the advisor can get to know what your actual intended goals are so that they can create the correct scenarios based on what you are trying to accomplish. In the third piece here, analyzing and evaluating. So that's just putting together scenarios, creating the plan, and then trying to find the best way to get those goals accomplished. And then actually putting the plan to work, so implementation. So we want to get to retirement. So what are we doing to do so? Are we contributing to our employer-sponsored plan? Are we getting close to that 10% mark? If we're there, can we try and max out the 401k? Can we do any contributions to an IRA on the outside? So it's actually putting that plan to work, so implementing that plan. And then that fifth piece, reviewing and managing the plan. So, that's something that's going to be based upon an individual's specific needs. Maybe your younger individuals would have reviews to manage the plan a little bit more frequently because they maybe have a few different goals that they're trying to accomplish. Saving for kids' education, paying down debt, student loan debt, whatever it might be, purchasing a home. So maybe that would require a little bit more management and reviewing, whereas saving for retirement, getting to retirement, once you're in that, maybe you're only reviewing it a couple times a year, once a year. So again, that's just an ongoing process that you'll continue doing as goals are continuing to come up. So I just put together also kind of like a handful of goals that a financial plan can illustrate for you. So there's plenty of other ones that aren't on here, but these are kind of the main ones that I focus on, or big ones that come up when I meet with clients. So, retirement, of course, is everyone's major goal, right? Getting to retirement. Saving for kids' education, cash flow planning and budgeting is a big one, especially for our younger individuals. Tax management is one that you'll pretty much do all through life. So whether you're in your accumulating years or if you're into retirement, the tax planning strategies are always going to be part of anyone's financial plan. Estate distribution, of course, that's going to be one that's closer to the later years. Paying down debt, in our accumulating years, and then saving for big expenditures. So this is just a handful of items where we can put those in, and then we can kind of come up with different ways to accomplish those goals based on a set account, or trying to figure out, budgeting, cash flow planning to get some of those savings and paying down debt down. So it's very versatile, and it's going to be unique to each client's needs. So why is a financial plan important? So these are just a few of the reasons I put together for why I stress so strongly getting a financial plan done. So here, allowing you to establish and work towards goals. For me, I find that it's that tangible piece that you can hang on to rather than just saving into all of these different accounts and then never actually knowing what's being accomplished. A lot of times, especially as you're younger and you're just putting money away into your 401k or your IRA or whatever it might be, you're just putting money away, but we're not actually seeing what's going to happen with it. So it's that tangible piece that you can actually hang on to and really look at and say, okay, so if I continue doing this, this is what we're projected to do. And so I can retire at X age. So it's really, again, that way to actually put those goals down and actually start working towards them. And then the second piece that goes hand in hand with that is being able to hold you accountable for staying on track. So if we put the plan together, but things aren't actually coming out the way we said they would, where is that disconnect? So making sure that both the advisor and the client are doing the things that they're supposed to be doing to make sure that that plan continues to stay on track. I would say this third piece is the most important thing that I stress, especially as I'm meeting with clients during volatile times. Centralizing the planning to focus less on day-to-day market fluctuations. So any advisor that's using some type of planning software to create a financial plan for individuals is using something that's projecting different times of market returns. So we know that from now until the end of someone's retirement plan, the markets aren't going to be positive forever. That's just not realistic. So when we're creating plans, we are taking into consideration market volatility. So we are creating times of March like we went through. March wasn't quite as bad as 2008 was. 2008 wasn't quite as bad as 1929 was. So those pieces in our history are incorporated into all of the market returns that create a financial plan. So if we can kind of centralize it onto that planning piece for the financial plan and meeting those goals, it makes it a little bit easier to go through those times of volatility when we do see it, because we know that we're still on track because it's already kind of been priced into that plan. And then the fourth piece here, just creating a visual tool. So this again is just that tangible piece. I kind of compare this to, when I start to think towards the weekend and there's like a list of items I want to get done, and then all of a sudden I just have all these things going around in my head, and Sunday rolls around and I'm like, well, what did I actually get done this weekend? With the creating of the visual tool, unless you actually write that stuff down and you're checking those boxes off, you don't actually know if you're getting it done. So that's what that financial plan is allowing you to do. It's creating that tangible piece that can hold you accountable so that you're actually getting those goals accomplished. So a key takeaway here, update your plan when goals change, review your plan often, remember to focus on the long-term objectives. We don't want to make short-term decisions based on short-term volatility that are going to affect our long-term goals. So we want those to be in line with each other. And then just remember that market volatility is only one component of the financial plan. So getting to those end goals, that volatility, no matter how uncomfortable it is, it's only one component. And then lastly, the market update. So I'm just going to do like a brief overview here, kind of to show history, where we're at today and where we're headed. So what does history tell us when we talk about the market? So one thing that I always try to find as comfort, I guess, during times of volatility is where have we been in the past versus kind of where we're at today. So I heard this from many clients as I spoke to them over the last few months, and maybe you've had these same conversations as well, but we're in unprecedented times. We've never been through something like this before. How are we going to recover from it? And that is absolutely true. We've never been through times that are exactly the same as this. But the unique part about the bear markets that we've been through in the past, it's the same story. The financial crisis was unique to 2008. The tech bubble was unique to itself in early 2000. So any of the different bear markets that we've been through, they've pretty much always come during unprecedented times. And the one thing we do know about history is that they've always been followed by a subsequent bull run. So this chart is really just to illustrate, 12 of the major pullbacks that we've seen, or the major bear market recessions that we've seen, basically going back all the way to the crash of 29. So one thing that I also like to put into perspective as well is where we were actually at when we looked at that negative rate of return for that short-term volatile time that we saw in March. If we talk about what we call the peak to the trough, so the highest point to the lowest point of the market, that highest point down was about a 36% drop when we talk about over about 2 weeks that we had seen the volatility that hit. If we kind of put that into perspective with some of these other bear markets, you'll see that back in 2008, it was about a 57% drop. Moving backwards to the one before that, it was about a 49% drop. So just trying to put those into perspective, that because they're so few and far between, and there's quite a few years between each one of them, we just tend to forget how uncomfortable they are every time they come around. And each one just feels like it's worse than the last one. When in reality, we were pretty much right back to even, so to speak, or kind of on that recovery period much quicker this time around. So just one thing, obviously history can't project what is going to happen in the future, but it has been a good indication so far, and it's really all that we know and all we can base any sentiment about the markets on. So that's just kind of to illustrate that even though we've been in unprecedented times before, we have come through each time. So where are we at today? We've seen a lot of positive momentum over the last 2 months. with some of the actions that have come out from the Fed, putting more money into the market, creating liquidity, purchasing up bonds. So that's really helped create some positive momentum over the last couple of months, and mostly why you've seen such positive reinforcement in the market over the last couple of months. I think they stepped in a little bit quicker this time than they had back in 2008, and I think there's a reason behind that to keep us from going lower than we had in the March timeframe. So that was definitely a good thing for the market. The stimulus packages that were put out also created some of that positive momentum. And then investor sentiment has just become much more positive, mostly due to fears of a second shutdown are starting to diminish. So that's kind of created a positive momentum on the investor side as well. And obviously, as investor sentiment continues to increase, people will be more comfortable putting money to work in the market. So where are we headed? There's a couple outliers that do still cause for concern as a person in my position. So, you know, we talk about a second wave. Would that be an outlier of a second wave of COVID happening where areas may need to shut down temporarily? I think we've seen that many areas talk about not doing a full economic shutdown again, but I think it's still just an outlier that we don't have too much data on to know what could happen. And then I think the second piece of that is the recovery period. So when are we going to see companies completely up and running at full capacity again, rehiring all of the individuals that maybe had to be laid off or furloughed? I think that's more of an important piece. That's going to be the one that takes a little bit longer. You know, some areas in the market you'll see do bounce back much quicker than other areas. You know, for instance, I feel that the travel industry might take a little bit longer to recuperate versus the retail side of things. So again, that's going to be the other big outlier as well. Key takeaways here, you know, while we're in unprecedented times, the market has been through the unprecedented times before, and that history has just always shown us that staying the course, even through drastic market volatility, has rewarded investors over the long term. So just kind of keeping that same sentiment in mind the next time we go through volatility. So I will open it up for if anyone has any questions currently. Otherwise, if you want to speak with me privately with questions, there's my contact information as well.
All right, no questions? All right, thank you, Andrea. This information was very helpful and very much appreciate you being on the call today. Thank you everyone for attending. Have a great day.
Thank you. Have a good day.